The Fed just took a hammer to the silver rally. One trading session, one quiet decision inside a stone building on Constitution Avenue, and nearly 5% of silver's value vanished from the board. The metal that had been climbing toward $90 an ounce, that was breathing on the doorstep of a brand new historic record, suddenly found itself wounded, shedding $4.20 in the span of a few hours. But here is what the mainstream coverage is leaving out. This was not a market accident. This was not panic in the streets. This was something far colder, far more deliberate. Somewhere behind closed doors, a decision has already been reached about the future of money in this country, and silver was the first casualty to feel that cut. What plays out in the weeks ahead, across the next 3 Federal Reserve meetings, could either bury this rally permanently or ignite the most explosive silver comeback this generation has ever seen. Welcome back to CSC Alert, the home of serious economic thinking for serious people. Before we go any further, do a small favor for an old friend. Reach over and tap that subscribe button the same way you would pick up a trusted newspaper you have read every morning for the past 3 decades. It costs you nothing, but it tells us you want the truth delivered straight to your screen every single day. And while you are at it, leave a comment below and let us know where in the world you are watching from today. A quiet kitchen in Texas, a rainy afternoon in London, a balcony in Karachi, or a study somewhere in between. We genuinely want to know who is sitting on the other side of this screen. Because what unfolds in this video, what happened to silver today, and what the Federal Reserve is quietly engineering for the months ahead will not stay contained to Wall Street. It will reach into retirement accounts, into personal savings, into the value of every ounce of metal sitting in vaults across the globe. So settle in, pour yourself something warm, and let us walk through this together. Because the silver story is nowhere near finished, and the next chapter is going to catch almost everyone off guard. The story starts on a single trading day, a day that felt ordinary to most of the world. But inside the silver market, something snapped. The metal that had been marching higher for weeks, pushing steadily toward the $90 level, suddenly reversed and dropped with a force that left even veteran traders shaken. Silver fell by nearly 5% within a matter of hours. To put a precise number on it, the metal lost 4% and 81 cents of its value, sliding $4.20 in price and settling near $83.42 an ounce. For a market that had been celebrating fresh highs, this was a sharp and sudden reminder that no rally climbs in a straight line forever. What unfolded next was even more telling. During that same session, silver dipped as low as $83.11 after touching a peak of $88.55 earlier in the day. The spread between that high and that low told its own story. A story of confidence fracturing, of buyers pulling back, of fear creeping quietly back onto the trading floor. Across the broader metals complex, the damage was widespread but uneven. Platinum and palladium both dropped more than 3%. Gold, the elder statesman of precious metals, lost under 1%, slipping just 0.85%. But silver carried the heaviest losses of any metal that day. It absorbed the most pain and bled the deepest. The picture sharpens when one examines the gold to silver ratio. After the sell-off, this ratio widened to 55.88, still just beneath the 56 level. To the untrained eye, that number is meaningless. To the experienced investor, it signals that silver is still in contention, still holding its strategic ground against gold, even after absorbing such a fierce blow. But the real question is not how much silver fell. The real question is why it fell. And the answer has nothing to do with mining output, factory demand, or geopolitical headlines. The answer lives inside the walls of the Federal Reserve and inside the quiet calculations of every major trading desk watching what the Fed intends to do next. For months, the precious metals rally had been quietly powered by one central assumption, that the Federal Reserve would soon begin cutting interest rates, that cheaper money was on the horizon, that a softer dollar would carry gold and silver to new heights. That belief was the engine driving the rally forward. Now that engine is being switched off. Traders have begun removing the possibility of a rate cut from their models. The expectation of easy money this year is fading fast. And once that expectation started to dissolve, the ground beneath silver became unstable and the selling began. This shift did not arrive through rumor or guesswork. It came from hard, measurable data. The Federal Reserve's own meeting calendar and the market's pricing of what will happen at each one tell a clear and uncomfortable story. The rate cut dream is dying. Behind this lies a larger transition. Kevin Walsh has been sworn in as the new Fed chair, not merely appointed to the board. His arrival was expected by some to bring a gentler touch to monetary policy, but the market is interpreting the signals differently, and no dovish shift is being reflected in current pricing. The implications for silver are immediate and serious. A metal that climbed on the promise of loosening policy must now defend its price against the prospect of tightening policy. Those are two completely opposing environments, and silver was caught in the crossfire at the exact moment of transition. For the business community watching this unfold, the lesson is stark. Markets do not always fall because of disasters. Sometimes they fall because a single expectation changes. Sometimes one sentence from a central banker carries more weight than 1,000 tons of metal crossing the globe. The story now shifts toward the Fed itself, toward the meetings ahead, the probabilities being priced in, and the data that explains why silver was crushed in a single session. The next layer of this story reveals itself not in charts or news wires, but in one tool that most ordinary investors have never encountered, the CME FedWatch tool. It is here, inside the cold mathematics of probability, that the true reason for silver's collapse becomes impossible to deny. This tool tracks what professional traders are actually wagering on. It displays meeting by meeting what the smart money believes the Federal Reserve will do with interest rates. And what it is showing right now is a quiet, brutal repricing of the entire silver narrative. Begin with the June 17th meeting. This is the nearest decision on the calendar, the one that should carry the most certainty. And yet, only 2.6% of market participants believe the Fed will deliver a quarter-point rate cut at that meeting. 2.6%. That is not optimism. That is the last breath of a dying expectation. Step forward to the July 29th meeting. Here, the numbers grow even louder in their silence. A massive 95.3% of participants expect the Fed to leave rates completely untouched. Only 2.6% still hold on to the idea of a cut, while 2.1% are already pricing in something far more unsettling, an interest rate increase. That last figure is small, but it is not irrelevant. It is the first fracture in the wall. It is the first moment the market begins to murmur a word that silver investors never want to hear: tightening. On the operational side of the market, this kind of shift quietly reshapes portfolios long before the general public understands what is happening. Hedge funds reposition, institutional desks rebalance, and metals that rose on the promise of cheap money begin to lose their footing. The story turns harder at the September 16th meeting. Here the consensus begins to break apart. Only 83.7% still expect rates to hold steady, but 13.7% of participants are now betting on a quarter-point rate increase. 13.7% is no longer a quiet murmur. It is an alarm. What follows is even more striking. By the late October meeting, the hike camp has grown to 23.9%. Nearly 1 in 4 traders now believes the Federal Reserve will push rates higher, and the cut camp has shrunk to just 1.9%. The easing dream has nearly disappeared from the calendar entirely. Then comes the final gathering of the year, the December 9th meeting, and the numbers there are the most aggressive of all. 34.2% of participants now expect a quarter-point rate increase. Another 6.9% are pricing in a full half-point hike by that stage. Only 1.5% still believe a cut is coming. Assemble those numbers, and the message becomes impossible to misread. The market is no longer debating whether the Federal Reserve will ease. The market is debating how aggressively the Federal Reserve will tighten. That single shift in framing is what destroyed silver in one session, and it is what continues to cast a shadow over every attempt at recovery going forward. Beneath this lies a deeper truth. Markets are not moved by what is happening today. They are moved by what participants expect to happen 6, 9, 12 months from now. And right now, every major trading desk is repricing the future of American monetary policy and rewriting the silver story in the process. Kevin Walsh's arrival as Fed chair was expected to soften the room. Many believed his confirmation would bring a more flexible, more market-friendly posture. Yet the FedWatch numbers tell a different story. The hawkish lean has not softened. If anything, it has hardened. For silver, this matters enormously. The metal built its ascent on the foundation of a weakening dollar. Strip that foundation away and the entire structure begins to tremble. The rally did not die because silver became less valuable. It died because the dollar became less likely to weaken. What this means for the chart, for the support levels, for the geopolitical wildcards still in play, is where the story moves next. The picture deepens, and the next section begins with the technical map. What comes next pulls the story away from policy rooms and into the world of charts, lines, and quiet technical levels that determine where capital flows when emotion takes over. Because while the Federal Reserve may have struck the match, it is the technical structure of silver itself that will decide whether this fire burns out quickly or spreads into something far more serious. The first number every serious trader is watching right now is $79.66. That is the 20-day exponential moving average for silver. In plain terms, it is the dynamic floor beneath the recent rally. As long as silver holds above that line, the broader uptrend remains technically intact. A break below it, and the entire conversation changes. The story then turns to momentum. The relative strength index, one of the most respected measures of market energy, is currently sitting near 68. That figure tells a layered story. It confirms strong upside momentum, the kind that powered silver's run toward $90, but it also carries a quiet warning. The metal is approaching overbought conditions. Overbought does not mean finished. It means extended. It means buyers have been carrying the weight of this rally for too long without a rest. And when a market becomes extended, even a small spark like a shift in Fed expectations can produce the violent correction the world witnessed in the last session. Behind this lies a deeper structural picture. As long as silver holds above the $79 floor, every pullback from here will likely be read by serious capital as a corrective pause inside a larger uptrend, not as the death of the rally. The momentum conditions suggest that any consolidation could be shallow before buyers attempt to push the price higher once again. Now look upward toward resistance. The number that matters most is $90. This is not merely a technical level, it is a psychological barrier. Markets tend to treat round numbers with enormous respect, and $90 has become the line in the sand for silver. A decisive move above 90 would open the door toward the next major objective, the March 2nd high near $96.62. But that level feels distant tonight. Silver is well below it, and the road from 83 back to 96 is no short journey. Even a recovery in the near term would struggle to reach $88. Anything beyond that in the immediate window would be a genuine surprise to most professional desks. The picture broadens when one looks past the chart and into the world stage. At the very moment silver was selling off, another story was quietly unfolding. The meeting between the Trump administration and Xi Jinping. The opening hours of that encounter, according to officials close to the discussions, have been described as constructive. Yet the deeper question hovering over the room is not what was spoken. It is what can be trusted. Trust but verify. That old phrase has returned to the table, and with good reason. Chinese leadership has historically offered commitments that did not translate into genuine structural shifts. The world remembers how 2020 played out. On the practical side of these negotiations, several themes are dominating the agenda. Iran, oil, Taiwan, trade flows. But one critical subject is absent from the public talking points. Critical minerals, rare earths, and silver-adjacent supply chains. No mention, no framework, no public agreement. That silence is significant because China continues to accumulate silver at scale. Sovereign demand from Beijing has been one of the most powerful invisible pillars beneath this rally, and that demand has not paused. While Western markets reprice the Fed, Eastern capital keeps loading up on the physical metal. The COMEX angle adds another dimension. The exchange recently reduced margin requirements on silver contracts. In straightforward terms, this makes it less expensive for institutions, hedge funds, and large speculators to open new positions. Lower margins tend to attract fresh capital, and fresh capital tends to amplify whichever direction the market is already heading. Whether major players like Jane Street will return to silver in size remains an open question. Their footprint in previous cycles was significant, both on the way up and on the way down. Even a partial re-entry by major desks could reshape the liquidity and volatility picture for the remainder of the year. What all of this means for the strategic outlook is where the story arrives at its conclusion. The final chapter is not about what already happened. It is about what comes next and what the serious decision makers of the business world must understand before the next session opens. Because the crash that shook silver was not a conclusion. It was a signal. Reading that signal correctly is the difference between protecting wealth and watching it erode. Three forces now govern the silver market, and each one pulls in a different direction. The first is the Federal Reserve, with its hawkish drift and its closing window for rate cuts. The second is the technical structure of silver itself, stretched near overbought territory and now searching for new ground to stand on. The third is the geopolitical landscape, with the Trump and Xi negotiations still unfinished and unpredictable. The base case scenario, the one most professional desks are quietly preparing for, looks like this. Silver consolidates somewhere between roughly $77 and $83 over the coming sessions. The market absorbs the new hawkish reality. Weak hands exit, strong hands wait. Then gradually, a reaccumulation phase begins. This is not collapse. This is rotation. The metal does not need to fall further to reset. It simply needs time for the market to digest the change in Fed expectations and rebuild conviction from a lower technical base. But the picture sharpens when one considers the trigger conditions that could break this base case in either direction. On the bullish side, a single geopolitical shock could send silver vertical within days. If the Strait of Hormuz situation shifts suddenly, if oil prices collapse, if gasoline prices drop sharply at the pump, the entire inflation narrative changes overnight, and the rate cut bets could come flooding back into the market. In that scenario, silver would not climb. It would explode. The same psychological forces that crushed the rally in one session could lift it with equal violence in the opposite direction. Markets that fall on expectation can rise on expectation just as fast. On the bearish side, the trigger is colder and more mechanical. If the September and October Federal Reserve meetings confirm a clear tilt toward a rate increase, the $79 floor will not hold. A confirmed break beneath that level would likely accelerate selling toward the low $70 range and potentially lower if institutional momentum turns decisively negative. What separates a temporary correction from a structural reversal is not price. It is conviction. And the conviction of the largest silver holders remains for the moment intact. The structural bull case has not been broken. It has only been stress tested. Underneath all of this lies the most important truth in the entire story. China continues to accumulate silver at sovereign scale. Industrial demand from solar panel manufacturing, electronics, and emerging technologies remains structurally constrained. The gold-to-silver ratio, even after the crash, still favors silver on a relative value basis. None of these foundations have been altered by a single Federal Reserve repricing event. For the business community, for the entrepreneurially minded, for the serious investor watching all of this unfold, the strategic message is precise. This is not the end of the silver cycle. This is a repricing event inside a longer structural bull market. The men and women who position themselves during this consolidation, rather than chasing the next breakout above $90, will be the ones who own the next leg of this rally. History rewards patient capital, not panicked capital. The crowd that sold today out of fear will be the same crowd buying back in several months from now at higher prices after the metal has already moved. That is the eternal pattern of precious metals markets. Silver is no exception. The Federal Reserve has paused this rally. It has not ended it. The real question is no longer whether silver finds its way back above $90. The real question is who is quietly accumulating while the headlines are screaming collapse, and who is selling at the bottom because fear has taken over. What unfolds in the coming weeks will determine the answer. The next Fed meeting, the next move from Beijing, the next inflation data print. Each one is a switch that could ignite the next leg of this story. For now, silver waits. The serious capital waits alongside it, and the world watches to see which side moves first.